Hi, I'm Andy Cocktaildress from Co-op Culture, and welcome to another in our series of short instructional videos for co-ops, community businesses, and their development workers. In this series, we're looking at gearing ratios and how we use gearing ratios to work out what is the best source of capital for a co-op or community business. This particular video, we will be looking at the EBIT, or earnings before interest and tax, to interest payable ratio. What are gearing ratios? Well, gearing ratios are formulas that, in general, we apply to what is now called the statement of financial position, which is what used to be called the balance sheet. However, when I say in general, what I mean is apart from this one. The EBIT to interest payable ratio, we actually get the information from the income statement or the statement of profit and loss. We use them to extract information about a co-op's capital, the relationship between different types of capital, and therefore what capital should we use when we're what capital should be raised if we need to raise more capital. The EBIT to interest payable ratio, or the earnings before interest and tax to interest payable ratio, is a really useful measure. And what it looks at is how much profit do we make? And it compares that figure with how much do we spend paying back the interest on whatever capital we have, whatever debt capital we have. And the way we calculate it is we get our net profit, and then we add back in the interest and the tax. So we're just looking at what have we managed to generate as a business. We've got our turnover. We subtract from our turnover our cost of sales to get our gross profit. We subtract from our gross profit our overheads to get our EBITDA, and we subtract from our EBITDA which is earnings before interest, tax, depreciation, and amortization. We subtract from the EBITDA the depreciation and the amortization to get our EBIT. We divide our EBIT by interest payable, and that gives us a relationship, and it shows us how much of the money we're managing to generate through the day-to-day trading of the organization are we using to pay back interest on our loans. So we should use it in two ways. We can use it to look at what the current position is, so we can see how much of our trade is going to pay off our interest. But we should also calculate what it would look like after we've done whatever the planned capital raise is. Yeah. It's really simple. If this ratio is high, then we can afford to take on debt as a source of capital. We have got much more earnings than we are paying out as interest. Yeah, very simple. If it is low, then we will struggle to pay more interest if we took on more debt. Yeah, what it means is the vast majority of the money that we're generating, if the EBIT to interest payable ratio is low, then the majority of the money that we're managing to generate as a business, and the profit that we'll have at the end is actually being used to pay interest or to cover the cost of capital. And if that is the case, and would mean that if we took on more debt, we would struggle to pay the extra interest, the business should consider equity as a source of capital. So that was the last video in the series on gearing ratios, which is looking at the EBIT to interest payable ratio. If you have any comments about this video, please leave them in the comments section below. For more informative, short instructional videos for co-ops, community businesses, and their development workers, please subscribe to the channel. If you wish to be notified when we upload more videos, then click the notification bell. If you like this video, click the like button. I hope you enjoyed it. I hope you found it informative, and thanks for watching.